The Federal Reserve wants lower stock market prices, not for them to be mean, but it's likely what they're targeting considering where inflation is. We had an interview last week from Bill Dudley, the former Fed, uh, uh, from the New York Fed, and he indicated something really very similar along those lines. So the question then is, why is the S&P 500 still only about 6, 7, or 8% off the recent highs? Well, it was lower, of course, but it's rebounded sharply. I want to address that question in just a minute. But here's the inflation number. We all know it's 7.9% year over year. Was the CPI print for of the month of February? Came out in March. We're going to get the latest print here coming up in a few days this coming week. But this is unacceptable to the Fed, and they want to rein in inflation, which really also means they have to rein in stock prices. So one way to think about this is if the Fed is accommodative, meaning injecting liquidity into the market, just think about the second half, or really the second, third, and fourth quarter of 2020 out of the COVID. What did the Fed do? They injected a lot of liquidity. Of course, there's tons of examples like that in the past. That's just the most recent ones. And stock prices went vertical, right? That's basically what you're looking at here on this chart. Let me get rid of a couple of things here so as to make this a bit clear, but basically the S&P 500 had a very sharp move higher. Well, now the Fed is doing the opposite. Not only are they looking to raise rates, they have started doing that. The yield curve is pricing a lot of that in, but they're also looking to reduce the balance sheet, rolling off bonds, letting them mature, but also actually talking about asset sales, meaning actually forcibly selling down bonds they hold, which of course would further increase bond yields, one would think, if it wasn't already priced in. That's another discussion, but more importantly, that's what they're trying to do. So by basically being irresponsibly long stocks now, if one believes not fighting the Fed, one is kind of fighting the Fed. Just like one would not want to be short stocks when the Fed is injecting liquidity like they did in 2020 and the year after out of COVID, one wouldn't necessarily want to be irresponsibly long stocks now because they're reducing liquidity. Right? That's important. But so now, why is the S&P 500 only really a little bit off the highs? Well, one thing we can do is we can look at the constituents of the S&P 500 broken down by sector. We're going to look at the S&P 500 SPY ETF tracking vehicle, which tracks the S&P 500. And if you look at the left-hand column here, you can see, or table, you can see the makeup of the S&P 500 by sector. And of course, technology is the biggest one, still about 27.5%. But let's look at a couple other ones that accumulative together are actually a decent chunk of the S&P 500. We're going to look at those charts in just a second. Healthcare, 14.2%. How about consumer staples? 6.34%. Energy, almost 4%. Utilities, almost 3%, and materials about 2.6%. Now, keep some of these in mind as we look through a couple of charts. Let's have a look at the XLV, Healthcare ETF. What is that thing doing? Well, it's definitely not breaking down. In fact, if anything, it's breaking out to new highs. How about utilities, which we also just talked about? What are they doing? They're not going lower. They're going higher. They're breaking out. How about energy? It's been a dog for a decade plus, making new highs almost every week. How about materials? A bit less directly related, but these things too have things like mining stocks and things like in there. They're holding in there. So you're looking at roughly between 25 and 30% of the S&P 500, which I just showed you here, making up these sectors, is acting really well. And that is why we have yet to see the S&P 500 really drop in a more meaningful fashion. Now, I think that the NASDAQ 100 has maybe put in an important lower high the other week. And as we start to see funds have to maybe get some more margin calls or sell down more of their tech exposure, they might start raising some money in other parts of their portfolio as well, whether that is healthcare or something else that we just went through that looks quite bearish, and that looks quite bearish. And that is ultimately where we could see another and ultimately more meaningful leg lower at some point this year. So I really don't think we're in a new bull market where one has to be buying everything. The Fed is clearly trying to rein in inflation, and they are trying to get lower stock prices. Not to be mean, but that is an important part of how they're going to hopefully accomplish ultimately bringing down inflation. I hope this is helpful. Any questions, please let us know. Until next time, take care.